Let's be brutally honest. People are terrified right now. Everywhere you look, the conversations are the same. Fears about a United States recession, anxiety about inflation, concerns that the stock market is massively overvalued and ready to collapse. Investors are frozen, wondering whether now is the wrong time to put money into the market. And the mainstream media only fuels that fear, because fear sells. But here's the truth. Nobody wants to say out loud, a recession is inevitable. It's not a matter of if, it's only a matter of when. Recessions are woven into the DNA of our economic system. They are a natural part of the cycle. Expansion, peak, contraction, recovery. For the last 100 years, recessions have appeared almost every decade. They are built into capitalism. So yes, a recession is coming. No economist, no government official, no hedge fund manager, not even the greatest investors of all time can tell you exactly when it will strike. And that's the part that scares people the most, the uncertainty. But here, as the flip side, and this is the part almost nobody talks about because it doesn't to sell fear, recessions create more millionaires than any other economic environment. When the economy contracts and stock prices collapse, that is the moment when wealth quietly transfers hands, moving from the fearful to the prepared. Every crash in history has produced a generation of investors who became wealthy, not because they were geniuses, but because they stayed calm, educated themselves, and bought great assets when everyone else was panicking. Think back for a moment. After the 2000 dot-com crash, the people who bought companies like Amazon, when they were left for dead, turned thousands into millions. After the 2008 housing crash, those who invested in the recovery made fortunes. During the 2020 pandemic crash, the ones who kept buying saw generational returns in tech, healthcare, and digital infrastructure. That's history. It rewards the bold, not the reckless, but the prepared. Still, the fear is real. Many investors feel the market is dangerously inflated right now. AI valuations seem insane. Housing prices are breaking records even with high interest rates. The national debt has ballooned past $37 trillion. Credit card debt has exploded. Inflation is still eating away at savings. And now geopolitical tension is pushing uncertainty into every corner of the economy. So people hesitate. They say, maybe I should sit this out. Maybe I should wait until everything feels safe again. But here is the paradox. The moment things feel safe is always the worst time to invest. That's when prices are high, confidence is high, and the opportunity has already passed. Fear creates discounts, safety creates bubbles, and that's why smart investors don't try to time the market. Instead, they position themselves, they diversify. They protect their capital, but also keep themselves ready to strike when assets go on sale. Because that's all a recession really is, a clearance sale on the global economy. But protecting yourself during uncertainty requires strategy, not emotion. And historically, when the market falls, there are certain types of investments that tend to hold up stronger than others. Not perfectly, not always dramatically, but consistently enough that they have been used as hedges through multiple downturns. They are not magic solutions, but they provide stability when the market turns violent. To understand them, we need to look backwards, not to repeat history, but to learn from the patterns that keep showing up. While every crash has been caused by a different needle, different triggers, different fears, different environments, they have echoed the same underlying rhythm. Take the 2020 pandemic crash. The world shut down. Markets plunged more than 30% in weeks. Chaos, panic, people scrambling for safety. And yet during that same year, the S&P 500 ended up rising 18% from the start of the year to the end, because investors realized the environment was shifting. Meanwhile, gold gained roughly 25%, becoming a safe haven asset as fear took over. Go back to 2008. The housing market collapsed under the weight of subprime mortgages. Banks failed. Unemployment exploded. It was the closest the modern United States economy had come to total collapse. The S&P 500 fell 35%, but gold rose about 5%, and long-term treasuries surged nearly 28% as investors fled to security. Go further back to the dot-com crash between 2000 and 2002. The Nasdaq imploded, losing about 70% of its value. The S&P 500 fell nearly 37%. Yet gold prices rose around 22%, and long-term treasuries climbed about 45%. Defense stocks and consumer staples held far better than the broader market, because even in chaos, people still need food, soap, and national security. Different crises, different causes, same behavioral response. Fear moves money into safety. And that is the foundation behind the first major asset class historically used to hedge downturns: gold. Love it or hate it, call it old-fashioned or ancient, gold has been a store of value for thousands of years. When trust breaks, gold rises. It doesn't generate cash flow. It doesn't innovate. It doesn't create jobs. It just sits there quietly holding value while everything else burns. That's why it's called a hedge. Insurance for the economic system itself. That part's S, also why gold ETFs like GLD and IAU exist, allowing investors to gain exposure to gold without storing physical bars. And yes, some still prefer to hold physical gold, especially now when demand is rising dramatically. But here's the twist. Gold is currently breaking record highs even though we're not in a recession yet, and inflation has cooled from its peak. That means one of two things. Either investors are genuinely terrified of what's coming, or gold is entering a speculative bubble. No one will know until hindsight reveals it. And while gold has been surging in 2025, another debate has taken center stage. Is Bitcoin the new digital gold? During the 2020 pandemic, Bitcoin soared nearly 300%, while gold rose around 25%. But in 2022, when inflation spiked, Bitcoin fell about 60%, while gold stayed flat. In 2025, gold hit new highs, while Bitcoin fell sharply amid technology fears. At least for now, Bitcoin has behaved more like a tech stock than digital gold. The future will decide which identity it becomes. Meanwhile, something unprecedented is happening quietly behind the scenes. Russia has accused the United States of trying to devalue its $37 trillion national debt through a silent strategy involving stablecoins, crypto mechanisms, and gold accumulation, without informing the American people. If that accusation holds weight, whether true or exaggerated, the world financial system may be shifting in real time. And if you hold dollars, stablecoins, stocks, or a retirement fund, that shift will impact you, whether you're ready or not. And that leads us deeper into the second major asset historically used during downturns, one that flips in value when fear peaks. When fear takes over markets, money behaves differently. It seeks safety, stability, and predictability, even if that means accepting lower returns in exchange for protection. And this shift is what drives investors into the second major category of assets that historically strengthen during recessions: United States treasuries. A treasury is simply a loan that investors make to the US government. In normal conditions, they're considered boring, slow-moving investments. Nothing glamorous, nothing exciting. They're the economic equivalent of a fireproof vault. Durable, secure, and built for survival, not thrill. But when the economy begins to crack and investors panic, treasuries become one of the most desired assets in the financial world. Because when everything else feels uncertain, real estate collapsing, stocks crashing, companies failing, the United States government is still viewed as the safest debtor on earth. Historically, it always pays its bills, it has the military, global influence, and the world's reserve currency behind it. So when fear spikes, investors rush into bonds. They dump risky assets and buy treasuries for protection. And that S, when the strange inverse relationship becomes important, because treasury prices and yields move opposite each other. When demand surges and everyone rushes to buy them, prices rise and the interest rate paid to investors falls. When demand collapses, prices fall and yields increase to attract buyers again. This behavior becomes extremely powerful during recessions because while stocks are falling rapidly, treasury prices tend to rise. Not because they're incredible investments, but because they become the least risky place to hide. The data is undeniable. In 2020, when the S&P 500 whiplashed through a 30% crash, before finishing up around 18% at year-end. The long-term treasury ETF TLT gained roughly 18%. In 2008, while the S&P 500 collapsed 35% and global markets were devastated, TLT surged approximately 28%. During the 2000-2002 dot-com downturn, long-term treasuries climbed around 45%, while the Nasdaq lost an estimated 70% and the S&P 500 fell nearly 37%. The SY ETFs like TLT, 20-year treasuries, and IEF, 7-10-year treasuries exist because they are simple ways to gain exposure to this protective mechanism without buying individual bonds or navigating complex treasury direct accounts. But now something is different, something that wasn't present in previous crashes. The United States government is currently carrying a staggering $37 trillion of national debt, with interest expenses exploding faster than revenue. The debt to GDP ratio has reached levels previously seen only during wartime. For the first time in modern history, major countries and large institutional investors are openly questioning the long-term strength of the dollar. This concern is exactly why gold has been soaring and why Bitcoin is being discussed as a potential alternative. It's also why Russia publicly accused the United States of using a quiet financial strategy to slowly devalue its debt, potentially through a combination of crypto adoption, stablecoin expansion, and aggressive gold stockpiling, while silently letting inflation erode the real value of the dollars owed. If the accusation has merit, it would mean the United States could strategically reduce its debt burden without announcing a default, simply by reducing the purchasing power of the currency the debt is denominated in. That's what inflation ultimately does. It allows governments to pay back debt using weaker money. And if that is part of the strategy, whether intentional or accidental, it would change the global financial landscape in a massive way. This is where the debate intensifies. On one hand, the United States dollar is still the global reserve currency. The US economy is still the largest in the world. The US military still supports global trade. Treasuries remain the most trusted financial instrument on earth. On the other hand, nations like China, Russia, Saudi Arabia, and Brazil are pushing de-dollarization. BRICS countries are exploring gold-backed settlement systems. US debt is growing at a pace that math argues is unsustainable. Inflation has already damaged public trust. The world is searching for alternatives. So the critical question becomes, will treasuries continue to protect portfolios in the next recession the way they have for decades, or is the world entering a new financial era? That uncertainty is exactly why some of the world's largest investors are quietly positioning themselves in a variety of assets, not relying solely on treasuries, but using them as part of a broader defensive strategy. And that leads to the third category of investments that historically strengthen when markets fall: defensive stocks and defensive ETFs, assets built around the products and services people use no matter what is happening in the world. When recessions hit, people stop buying luxury items. They stop taking expensive vacations. They stop gambling on high-growth startups. But even at the bottom of an economic collapse, people still need soap. They still buy toothpaste. They still need groceries. They still need healthcare. They still need electricity, water, and medicine. And governments still fund national defense. That's why defensive stocks, especially those paying strong dividends, become extremely attractive during downturns. Investors want stability. They want cash flow. They want companies with predictable revenue and real products that survive economic storms. Dividend aristocrats, companies that have increased their dividends every single year for at least 25 consecutive years, are among the most respected in the market. ETFs like NOBL and VIG exist specifically to capture these companies without selecting them one by one. They're not the fastest growth vehicles, but in recessions they become magnets for capital because they represent stability, experience, and reliability. Then there are consumer staples, accessed through ETFs like XLP and VDC, representing companies that sell the essentials of daily life. During 2008 and during the 2000 downturn, while tech and growth stocks collapsed, consumer staples remained resilient and in some cases gained value because demand for basic needs doesn't disappear. It actually strengthens. And finally, there are defense stocks, accessed through ETFs like ITA and PPA. War, unfortunately, does not slow down during recessions. Conflict continues. Nations invest heavily in military capability, whether economies rise or fall. And in today's geopolitical climate, with conflicts across multiple regions, rising global tension, and record-breaking military budgets, that sector becomes a powerful defensive hedge. The combination of these elements forms a framework that many strategic investors use to survive downturns with minimal damage, and in some cases, emerge stronger. Which brings us to the most important takeaway so far. Downturns are where generational wealth is built. Not by panic selling, not by hiding in fear, but by preparing before the storm hits. Because when it finally comes, and it will, most people will be caught off guard, emotionally overwhelmed, and financially unprepared. They will sell at the bottom. They will freeze. They will regret. And a small percentage will be ready. They will have capital. They will have strategy. They will have courage backed by research, not hope. And they will buy valuable assets when they are discounted, just as history has rewarded over and over again. And now the question becomes, what is the needle that will pop this current bubble? What will trigger the next downturn? Where will the new opportunities emerge? And how will today's economic environment transform the landscape of global wealth? Right now, people keep using a phrase that should scare you more than any headline. Everything bubble, stocks at record highs, real estate stretched, tech valuations pricing in a perfect AI future, government debt exploding, crypto swinging wildly between euphoria and panic. And underneath all of that, ordinary people are quietly losing purchasing power as their savings get eaten by inflation they didn't know vote for and don't really understand. That's the environment we're in. And here's the uncomfortable part. Markets can stay irrational longer than you think. We could see prices go even higher. We could see AI stocks keep running. We could see more speculation. But just because the party is still going doesn't mean the floor is safe. At some point something breaks. It's always like that. In 2000, it was dot-com hype. In 2008, it was subprime housing. In 2020, it was a virus. This time, it could be an AI bubble, a credit crisis, a geopolitical shock, a currency event, or something nobody is talking about yet. That's why trying to predict the exact trigger is a losing game. The needle is always different. What matters is how prepared you are when it finally hits. Because when the next downturn comes, it won't send you a calendar invite. It'll show up as a sudden wave of red candles, collapsing asset prices, credit freezing up, and a flood of people saying, no one could have seen this coming, even though the warning signs were everywhere. Now layer onto that something even bigger, the global currency game. When Russia says the United States is quietly trying to devalue its $37 trillion national debt through the use of stablecoins, crypto structures, and gold, they're repointing at something most people never think about. Governments don't just play the game inside the system. They can change the rules of the system itself. They can print money. They can shift regulations. They can weaponize currencies. They can inflate away debt without ever announcing a default. And the average citizen only feels it as prices went up or my savings don't go as far as they used to. If you hold dollars, if you sit in stablecoins thinking they're safe, if your retirement fund is loaded with US bonds and overvalued growth stocks, you're in the middle of that game, whether you ask to play or not. You don't get to opt out. Doing nothing is still a bet that everything will continue as it has, that the dollar will remain dominant forever, that debt will never matter, that governments will somehow grow out of a math problem that no longer adds up cleanly. This is why wealthy families, hedge funds, and even central banks quietly diversify. They don't put all their trust in a single asset, a single currency, or a single narrative. They spread their exposure across productive businesses, real assets, hedges like gold, selective bonds, and sometimes even crypto. Not because they worship any of these things, but because they respect uncertainty. They don't just ask, how much can I make? They ask, What happens if I'm wrong? So where does that leave you as an individual investor? Someone who is not running a hedge fund, not controlling a government, and not moving billions with a single decision. It starts with accepting two truths. You will never have perfect information. You don't need perfect information to build wealth. What you need is a framework, a way of thinking, a system that doesn't fall apart the moment the headlines change. That is where everything we ever talked about comes together. The role of gold as a hedge when trust in currencies falls. The role of treasuries when fear spikes and investors run to safety. And the role of defensive cash-flowing businesses when growth stocks implode. That doesn't mean you blindly dump your money into random ETFs and hope for the best. It means you decide what percentage of your wealth you want in. Assets that protect you when things break. Assets that grow your wealth over decades. Assets that stay liquid so you can buy when others are forced to sell. For some people, that might look like a core of broad market ETFs, plus a slice of gold and a small allocation to treasuries or defensive sectors. For others, it might include exposure to quality individual stocks, some real estate, or disciplined strategy around Bitcoin or other crypto. The specific mix is less important than the principles behind it. Diversify intelligently, respect risk, and stay liquid enough to act when opportunities appear. Because here's what will happen in the next real downturn. At first, people will call it a dip. Then they'll say it's a healthy correction. Then, as losses deepen, they'll convince themselves it's temporary and that it will bounce. When it doesn't, panic sets in. That's when you see forced selling, margin calls, funds liquidating, people dumping great assets at horrible prices because they have no choice. They're over-leveraged, overexposed, and emotionally broken. This is the moment history has rewarded the prepared, not the people who wish they were prepared. Not the people who say, I'll buy when it crashes, but then freeze in terror when it actually does. The people who win are the ones who built a plan beforehand. If the market falls X%, this is what I buy. If sector Y crashes, this is the ETF I add to. If gold spikes too high, this is when I rebalance. If treasuries explode in value, this is how I rotate. That's not gambling. That's having rules. That's thinking like an investor instead of reacting like a spectator. And remember, investing always carries risk. You're going to lose money at some point. You will make mistakes. You will buy something that goes down. You will sell something too early. That's the price of admission. There is no strategy, no ETF, no asset class that guarantees safety and profit forever. Anyone promising that is lying to you. I'm not your financial advisor. I'm not here to tell you exactly what to buy or sell. I am here to push you to stop thinking like a passive consumer of financial content and start thinking like an owner. Someone who understands how wealth is quietly transferred during every single crisis. Someone who doesn't just panic when headlines scream recession, but asks, where is the opportunity? Who is being forced to sell? Which assets are being mispriced by fear? That's also why you cannot afford to blindly trust any random person on YouTube, TikTok, or Twitter, including me. Your money is your responsibility. Your family's future is your responsibility. Listen, learn, take notes, but then go and verify. Read the data. Study past downturns. Look at how gold actually behaved, how treasuries actually moved, how defensive ETFs actually performed. Build your own conviction instead of renting somebody else's. Because if Russia is even partially right, if the United States is quietly working its way through debt devaluation using currency tricks, stablecoin integration, and gold positioning, then the rules of the game are shifting under your feet. And the people who do nothing, who assume their cash, their stablecoins, their index funds are automatically safe, will wake up one day realizing the numbers in their account went up, but their purchasing power went down. So here's your real advantage. You're early enough to prepare. you still have time to adjust. You still have time to learn how to diversify, how to build a watch list, how to create an entry plan for the next crash instead of waiting for mainstream media to tell you what already happened. If you want help building that framework, that's exactly why I put together my free investing masterclass, to walk you through how to find hidden opportunities before they hit the headlines, and how my team and I research investments instead of gambling on hype. When you join, you'll also get access to my investor newsletter, where we break down what's actually happening in the markets in plain language. But whether you join or not, don't leave this video and go back to scrolling like nothing's happening. A recession is coming. Nobody knows when. The real question is not will it crash. The real question is, when it does, will you be one of the people wiped out, or one of the people quietly buying the future on sale? If this opened your eyes, the best thank you can give is a referral. Share this with a friend, a family member, a co-worker, or another investor who needs to hear it. The more people understand how this system really works, the fewer will be blindsided by the next surprise crisis, because it won't be a surprise. Not to you, not anymore.